Now, what is the disclosures of financial instrument given by IFRS 9? Their main disclosures are about the significance of financial instrument for entities, balance sheet, and performance. Significance of financial instrument for an entity's financial position and performance. And the second disclosure is information about the nature and extent of risk arising from the financial instrument, means significance of instrument to entities, balance sheet, and performance. And second disclosure is nature and extent of risk arising from the financial instrument. So these are the two main disclosures given by the required by the standard. The topic is embedded derivatives. Embedded derivative, I'm beginning with the definition. An embedded derivative is a component of a hybrid contract that also includes a non-derivative host, with the effect that some of the cash flows of combined instrument vary in a way similar to a standalone derivative. So, before I begin with this, what is the embedded derivative? A hybrid contract. A hybrid contract is a contract, host contract, or a base contract which has derivative embedded in it. Host contract can have different economic characteristics than derivative economic characteristic. So, what is the criteria? What is the accounting treatment? With regard to the accounting treatment of embedded derivatives, if the host contract is within the scope of IFRS 9, if the host contract is within the scope of IFRS 9, then the entire contract must be classified and measured in accordance with the IFRS 9 or with that standard. If the host contract is not within the scope of IFRS 9, that is not a financial asset, not a financial liability, then embedded derivative can be separated out and measured at fair value through profit and loss if there are three conditions. If the economic risk and characteristic of embedded derivative are not closely related to that of host contract. This means the economic characteristic of host contract and embedded derivative are different. The second point is a separate instrument within the same term as embedded derivative would meet the definition of derivative. And the second definition is the instrument that is present in the host contract meets the definition of derivative. Third criteria is the entire instrument is not measured at fair value, with changes in fair value recognized in profit and loss. Means host contract is not measured at fair value through profit and loss. So, what are the three conditions? Wait for a second. What is the accounting treatment? If host contract is within the scope of IFRS 9, the entire contract will be measured in accordance with IFRS 9. If host contract is not within the IFRS 9, means it's not a financial asset or financial liability, then embedded derivative can be separated out and measured at fair value through P&L. If economic characteristic of host contract and embedded derivative are different, the instrument in the host contract meets the definition of derivative. And third, host contract is not measured at fair value through P&L. We are doing this so to reduce the complexity. Host contract should be measured at fair value through P&L when its entirety. Because of the complexity involved in splitting out and measuring an embedded derivative, IFRS 9 permits a hybrid contract where host element is outside the scope of IFRS 9 to be measured at fair value through profit and loss in its entirety. For the vast majority of embedded derivative, the whole contract will simply be measured at fair value through profit and loss. Example of an investment in convertible bonds. An entity has investment in convertible bonds which will be converted into a fixed number of equity shares at a specified future date. The bond is a non-derivative host contract and the option to convert to the share is therefore a derivative element. The host contract, the bond, is a financial asset and it's so within the scope of IFRS 9. This means that rules of IFRS 9 must be applied to the entire contract. The bond would fail the contractual cash flow characteristic, and therefore the entire contract should be measured through fair value through profit and loss. I will be discussing reclassification. Before I will get into the topic of reclassification, firstly I am going to discuss what is the scope of this reclassification topic. Financial asset is divided into investment in shares, investment in debts, third investment in derivative speculation purpose, and others that include trade receivable, lease receivable, financial guarantee contracts. So the first one, the investment in shares, are measured at fair value through OCI and fair value through P&L. Since OCI is irrevocable elections, so once OCI is selected, you can't switch to the method profit or loss. But if you are in the method of if you are using the measurement method fair value through P&L, then you can switch to fair value through OCI in investment in shares. So but OCI in investment in shares is irrevocable. Now, investment in debt. Since investment in debt is measured using two methods, fair value and amortized cost method, and fair value is divided into P&L and other comprehensive income. Since OCI here is not a irrevocable election, so you can switch between fair value and amortized cost method as per your characteristics of your investment and your criteria. Derivative. Thirdly, derivatives are measured through fair value P&L, so there can't be any change in the reclassification. And others like trade receivable, lease receivable, financial guarantee contracts, they are based on the book value, so there is no reclassification. Reclassification is actually when you change the method of measuring the financial asset. Secondly, the financial liability. Financial liabilities are measured using two methods, amortized cost method and fair value through P&L. Reclassification of financial liability not possible. It is an irrevocable election. Financial liability are measured using two methods, amortized cost method, fair value through P&L. And it is irrevocable election just like investment in share. So reclassification is not possible. So what is the accounting treatment when there is a reclassification? Fair value at reclassification go in P&L. Reclassification always happen at the fair value. Subsequently, new method will be followed. Financial assets are reclassified when entity change business model. If hedge accounting discontinue, it is not called reclassification, and reclassification applies prospectively from the reclassification date. To summarize, the accounting treatment of reclassification is that fair value at the reclassification date, any change in the fair value go in statement of profit and loss. Reclassification always is at fair value. Subsequently, new method will be followed when financial assets